Welcome, everyone, to our final session of the day. Thank you for being with us through this powerhouse action-packed day. We've had 5 keynotes, we've had 6 panels, we've covered AI, we've covered defense spending, we've covered trade, and we are going to end the way this forum started in Frankfurt in 2022, the future of the euro and the future of the dollar. And so I am so pleased to bring up a distinguished panel. If they please join me on stage. Thank you. And please give them a round of applause.
Right here?
Yeah.
Thanks.
Okay, we're going to have fun in this final session. It's going to be interactive, so prepare your questions. I'm going to go to the iPad. I'm also going to go to the audience, and we have a lot to cover. The session title is provocative on purpose, the Euro's global moment, why this time is different. I know I already heard from many people in the hallway, they don't believe this time is different. Okay, message received on that. We will debate that here. Let me introduce our panel. To my left, Andreas Dombret, Global Senior Advisor Oliver Wyman, board member at the Bundesbank, supervisory board member at the ECB, and board member of the Atlantic Broker. Andreas, great to see you again. I remember having this discussion in Frankfurt. We will see what's changed. To his left, Daniel McDowell, senior fellow at the GeoEconomics Center, professor at Syracuse University. Dan, thanks for joining us here. To his left, Martin Mühleisen, former chief of staff at the IMF, director of strategy, policy, and review at the IMF, senior fellow at the Atlantic Council. And to his left, Elizabeth Shortino, senior fellow at the GeoEconomics Center at the Atlantic Council, distinguished career at Treasury, U.S. executive director to the IMF, a powerhouse panel to finish the day. We could not ask for better expertise to debate this question. I'm going to start by putting up some data, because that's what we like to do at the GeoEconomics Center. And I want to show our dollar dominance monitor, one of our newest flagship projects. And we'll put it up on the screen here. And I hope this scene sets our conversation a little bit. So here's the dollar dominance monitor. If you scroll down, and we'll see it on the back as well for those here so they don't have to turn around. Here, let's go to the dollar first as our scene setter. So if you go to the dollar, this is how we traditionally think of currency reserves panelists, and our panelists can look back here, and the audience can look here. We think of share of global foreign exchange reserves. We think of share of export invoicing. We think of share of foreign exchange transactions. This is what I would say are the traditional macroeconomic indicators of currency strength. If you tab over to the euro, as we will compare, these numbers, I would argue, are somewhat inflated because they account for intra-euro trade, so we can debate whether this is actually overstated. If you go over to the pound, and then the yen, and then the renminbi, I think this explains pretty clearly and quickly why Fed and Treasury make the argument frequently, there is no alternative to the dollar. And so the question is, and we can scroll down quickly just to see other parts. We'll go down, dollar's international use, you see the dominance clearly, you see euro as second. And if you go down further, this is our unique metric that we created at the Atlantic Council, how to evaluate the strength of a reserve currency. And there are different ways that we assess strength of reserve currency. Obviously, euro hits many of the metrics, but not the same as the dollar. So Andreas, I want to start with you. Is this time different? And specifically, if it's going to be different, there's going to have to be progress on capital markets. We just talked about that with Commissioner Dombrovskis, savings and investment union. How far has Europe gotten in making progress in what we would call the second column here for euro, in really the financial market dimension here, to strengthen that shade? That's really what we're talking about. See size, depth, openness of financial markets, that shaded right there. For that to get deeper, for the euro to really challenge the dollar, where are we?
First of all, thank you for having me. These shifts don't go quickly. They're not going to happen overnight. This 60-20 ratio is not going to happen overnight, but there are structural issues you have to think about when you think about, the coloring or the deepness of those numbers. Now, we have a new administration in the US, as we all know, and voices are very different, and what I hear is very, very different, and that will have an effect. You have quite a number of votes towards Europe right now, but let's go through this. You mentioned depth of capital market, correct, no doubt. You mentioned safe haven status. there I would argue Europe and Germany is also quite a safe haven. Nevertheless, how much debt is there? That I would add as a third category. There is quite some debt because and a lot of debt is issued. There's very few euro debt issued, mutualized debt issued. A lot of on the country level, debt on the country level, like Germany and other countries who are issuing debt. Now, Germany is still AAA. The mutualized debt, which is issued by Europe, is also AAA. So we have good ratings in Europe, and we are having more debt. Look at the German 1 trillion over several years, 1 trillion euro investment. So we're going to see more happening there. France really is the elephant in the room right now, but that's doesn't matter. There is a certain liquidity. There's no scarcity of liquidity, let me put it that way. The second thing is, if I might add, and I'm sorry to out-frighten you, the independence of central banks. And the question of how independent is the central bank? And there is a debate which I don't really want to lead between the Fed and the ECB, but that's also a point which is probably not on your list and shouldn't be, because that should be taken for granted.
When we created it 2 years ago, I didn't think we needed to do that.
I didn't think this either, and I feel very bad about this. The last point, which I think the commissioner started the discussion at the end of his panel or his fireside chat, was really what other means are there, which maybe weren't there either 2 years ago, and that's all the entire question about stablecoins, digital euros, tokenization, and of course that is a very, very dominant effect also in terms of funding. If you look at the fact that 99% of all stablecoins are US dollar denominated, that is going to help fund. So you have to take this into consideration either.
Well, that's certainly the argument of Secretary Bessent right now, that the issuance of dollar-backed stablecoins will increase dollar dominance. And I want to get to that, but I want to push you on something. I didn't prepare you for this. But given your role at the ECB, you said France, you kind of glossed over it. I have to ask, is there any situation going forward where the ECB has to intervene, given what's going on in France right now?
Well, it's not an easy question. With regard to the instruments the ECB have, there are two instruments. They still have the OMT instrument, but more importantly, they also have the so-called TPI, transmission progression instrument, whatever it's called, which has never been used, but which has been created a few years ago. This would be a problem to use it. I think the fact that this instrument is there in itself is good, because all the shorts in the market may well consider that there is this instrument. On the other hand, I personally think about this instrument as like a nuclear bomb. You want to have it and you don't want to use it because it causes so much damage. And it would lead to a discussion within the ECB, the governing council of the ECB. Are the rates of the French Trésor, are they elevated naturally or not? And that is a very political debate, and then fiscal policy and monetary policy blurs, and then the ECB would have to have a decision on that topic, which I would find very difficult, but they may have to do. I hope they don't.
Okay, so I'm reading that answer as unlikely, but leaving the door open. Thank you. Now, Martin, that transitions well to you, because really this gets to the heart of the issue, which is even if an opportunity's been created by instability in the US, by challenges to central bank independence, can Europe capture that opportunity? That seems to be the structural issue. Capital markets or savings and investment union is one element of that. But we've debated this now for a decade, back when we worked together at the fund. Have you seen real progress or ability to capture the opportunity to the extent it exists?
Yeah, there's been progress, of course, toward getting to a more integrated capital market. But we've heard earlier today that, for example, in the area of IT investments or AI investments or new corporate investments in general, the US is far outperforming the euro area or the EU. And I think the capital markets issue is part of that, that you just don't find it as easy as combining these funds and investing them because of all the different kind of regulations and institutional characteristics you have across countries. So there is a long list of things that could be done. Harmonization of rules, coordination of regulatory agencies, securitization, SME listings, etc., etc. This is all good, and progress would be welcome, but it's not decisive. That's not the issue. The fundamental issue is whether we're going to see the national states from withdrawing some of their responsibilities and handing it over to a more supranational within EU authority. Look, for example, at the Commerzbank saga in Germany. I mean, it should be the most normal thing that one bank, if there's a business case, has the possibility to take over another one. In the US, if a bank from the West Coast would want to get into an East Coast institution, no problem. Here you have all sorts of national issues involved, and you know the deal is not progressing. So it's tied to this broader EU agenda whether citizens believe that the costs of giving up sovereignty, for example, in that market regulation area, is really worth it, outweighs the gains, is smaller than the gains in economic efficiency and geopolitical clout. It's not just in the financial area, it's a broader issue. And I don't see that progressing at the moment.
Okay, I would take that as a pragmatic, given the theme of the day, assessment of the situation as it is. Elizabeth, let me turn to you. From the US perspective, does anything about the euro keep the Fed or Treasury up at night?
Great question. First, I want to make one comment, because there's been some commentary about the US and the dollar. And while I do think there was obviously some interesting analysis released by Stephen Myron at the beginning of the administration about, is a weak dollar better for the US? If you look at the rhetoric in the last few months, it really has been reinforcing that the administration's goal is maintaining dollar dominance. So that doesn't maybe say strong dollar, but it does say, you know, promoting dollar sovereignty, stability, sovereignty. So, and that has come out mainly through the White House's executive order on digital assets, also the digital assets report that was released. So I do think the policy is still very clear on dollar dominance. Now, in that context, do people at Treasury or the Fed worry about the euro being a threat to that dollar dominance? Well, I'm not there now, obviously, but if I were to put my Treasury hat back on, I think the answer is, of course, they monitor it, but an active worry, probably not, for all the reasons that we're discussing, some of the structural reasons there. I mean, and here I just get back to the sheer size of the US Treasury market, and it's very hard to replicate that with the euro market, and to find, and even if central banks wanted to diversify their foreign exchange reserves, it would be difficult to do that entirely into euros. And you see that with your very helpful dollar dominance tracker. Even as the US has gone down in terms of FX foreign exchange holdings, the euro has not gone up. It's been diversification into other currencies. And then you just have some very structural factors, I mean, not just around sort of the banking union, but also around current account surplus. And then the different fiscal policies and different risks associated with the different countries in the euro. So I think it's something that Treasury and the Fed should continue monitoring. I'm quite sure that they are. But an active worry around threats to dollar dominance, probably not.
And no more worried since the beginning of the Trump administration than they've been before?
Well, that depends on who you ask, right? If you're going to ask the civil servant, or if you're going to ask the political person. I mean, if anything, I think this administration is looking at the Genius Act as really solidifying that dollar dominance. And you'll see it all over their press around that piece of legislation. And I think it does have some potential to do so, especially as stablecoins really grow into, you know, a bigger source of payments.
Okay, this is the second time stablecoins have been invoked, so we definitely will cover that and debate a little bit whether they actually lead to dollar dominance, as many have said, and Chris Waller told us at the Atlantic Council in February. But Dan, I want to turn to you, because we've been talking about the macroeconomic role of the dollar. We've been talking about currency, invoicing, we've been talking about foreign exchange reserves, But there's another role of the dollar. This is core to our work at the GeoEconomics Center. I know it's core to your book, Bucking the Buck, which is how the dollar's used in national security. Now, these two things are, of course, interconnected, but not always moving in parallel. Countries can work around sanctions and undercut the dollar without touching any of the metrics on our dollar dominance monitor. And I wanted to hear from your perspective, whether on that front, on the national security front, you see an ebbing and erosion from the dollar, and especially when we think about Russia's invasion of Ukraine and the G7 sanctions response. There was a lot of diversification from Putin into euros before the invasion. If you go from 14 to 22, you can see that strategy. But that strategy didn't pay off because the G7 worked together on sanctions. Is it different now in the Trump administration with the divisions we've been talking about on other fronts throughout the day? Does that change the dollar-euro calculus that maybe countries have been thinking about over the past few years?
Yeah, thanks for the question. So there's really two parts to that. The first is, do we see erosion in the dollar's role because of the United States' use of sanctions first? And then second, what about the euro? Because they were in on the sanctions game with Russia too, right? So on the first question, I think the answer is yes, but it's concentrated, right? It's concentrated among a small number of states that have real legitimate concerns about facing sanctions, or countries that have already been sanctioned. Obviously, you can look at Russia. Russia has de-dollarized, right? It's de-dollarized because it had no other choice. It was pushed out of the dollar system, so it's had to seek alternatives. China's been a key partner in that agenda. China, of course, has also been really active in the last few years promoting the yuan in trade settlement in particular, and other areas. And that's driven, in my view, more because of geopolitical considerations than because of economic motives. I think if we go back before 2015, the motive to internationalize the currency was more because of economic risks. I think that's shifted today. I think it's because of sanctions. So that's the answer to the first part. To the second part is, what about the euro? You know, the Europeans, and the euro was also used, weaponized against Russia. And so is it sort of stigmatized in the same way that the dollar has been stigmatized because of the United States' use of financial sanctions in the last few years? And I think the short answer is yes, it has been, right? Europe's decision to block Russian euro assets means that the euro is no longer viewed as an apolitical currency in some corners of the world. But I think if we zoom out, I think that actually says less about the euro specifically and more about our current geopolitical moment. I think the reality is that there really aren't any apolitical international currencies left in the world, right? For countries that are worried about sanctions risks or geopolitical risk more generally, there's no true safe haven. It's really just varying degrees of risk depending on where you sit. And so I think that's why we're in this moment where the imperative is diversify, because if you're not sure what the future is going to hold, it's best just not to have all your eggs entirely in one basket.
Let me just follow up on one point, your first point about sanctions eroding the power of the dollar, which I agree with. You know, we've talked about this and debated it. You know, the center agrees with this view. But I don't think the Fed agrees with that, and I don't think many people at Treasury agree with that view. I know because they've told me flat out they think I'm wrong many times. Why is that? Why are we disconnected on this sanctions erosion dollar point?
Well, look, first thing I'll tell you, if you're talking to economists, and this is no critique of economists, I'm a political scientist by training, so I talk to economists a lot. I have many great colleagues who are economists, but economists who focus on international currencies, they tend to think about the role of international currencies, the benefits of international currencies in a sort of econocentric way, as you would expect. They don't think about the political angle as much. You go back and read, research and writing in the last 20 years from an economist's perspective about the benefits of issuing the dominant currency. You don't see sanctions mentioned in there. It's not part of the way they had typically thought about it. It's eking its way in. But to your question, have sanctions eroded the dollar's sort of power in the world? Again, macro picture is no, not really, right? But has the United States' capacity to, let's say, use the dollar as a coercive tool against China diminished in the last 5 years? I think the answer to that question is yes. That doesn't mean the United States still can't weaponize the dollar against China and impose costs on China. But China has already moved in a direction to anticipate that move and try to minimize the impact. And so that's where the effect is, I think.
And Elizabeth, I just want to bring you in quickly on that. Is my reading correct of Treasury and the Fed?
It's absolutely correct. And
why do they feel that way?
I've been told the same thing, but I tend to agree, with your conclusion. If you look at the data, the dollar is it still dominates. But China has been taking these discrete steps, and they do have, more use of the renminbi in their sort of regional trade circles. So, and that's probably to try to diversify away from their reliance on the dollar. How effective it is, we'll see, but.
I'm going to come back to China in a moment, but let's stay with Europe for a second. Andreas, back to you. For years, when we talk not just about the digital euro project, but about payment systems in Europe, the argument we've always heard, we've heard it from Commissioner Dombrovskis, we've heard it from the ECB, is sovereignty. Europe needs sovereignty, and so we have to build our own networks. And that's not just about stablecoins. That's about payment systems. That's about credit cards. That's about MasterCard and Visa. And this is what you hear from Europe. Can you just unpack this argument a little bit? Because I only hear it from the euro area. I only hear it from the ECB. There are a lot of motivations to do domestic payment systems, but the sovereignty argument is one I've heard most, and it's not just about digital currency and stablecoins. I've heard it for a decade or more from the ECB.
Yes, but it's getting louder, these voices, because of what's happening since the beginning of this year. Now, I would have never thought I would have to answer a question like this about sovereignty of our payment systems, but it's becoming more relevant. And there are two things which you have to bear in mind. First, there are several smaller countries, also in the Eurozone, of course, most of them who don't have an own payment system and who are really 100% relying on Visa and MasterCard. So, because that was so convenient and never has been seen as a risk. So, it's not France or Germany who are really here, at stake, but it's a lot of countries within Europe and outside of Europe who don't have that. So that is, the sovereignty issue becomes more important. The second thing is we are just not at all harmonized in terms of payment systems in Europe. We have some countries who do quite well. Look at Spain, look at Italy. We have other countries, look at France, look at Germany, who really have very old payment systems. So we need to harmonize that in Europe, and we need to modernize that because it's really out of date. And that's where the question comes: do we want to give up and give up to MasterCard and Visa, very good firms, or do we need to do this on a European level? And that's where the digital euro comes back in again, and that's where the issue of tokenization comes back in again. But it's more not because of a Master and Visa card being ever so dominant, but because of the systems being weak and needing harmonization and modernization.
We have guests from MasterCard and Visa in the room, by the way, so I hope they ask you a question when we get to that in a few minutes.
I hope so too. Yeah.
Martin, I want to turn to you. First of all, this is Martin's report, which has been published a few months ago on the dollar, so I recommend it for everyone, A Strategy for Dollar Dominance. And Dan also just published a piece for us that's published today on the future of the dollar, so we'll share that research with everyone. But you testified to House Financial Services Committee a few months ago about the dollar. In part, your testimony was based on this report. And you talked about the fact, as we've all discussed, that in a crisis, people turn to dollars. We are facing a government shutdown tonight in the United States. It looks like we're headed toward. Sometimes we go through the debt ceiling in the US or come right up to the brink. In all of these situations, historically, treasuries have done well. Whether the crisis is created by US dysfunction or an external shock, the world wants the safe asset, which is treasuries. But we saw a break with that after Liberation Day. And the question is, has something fundamentally changed, or was that a temporary blip and we're a return to normal?
Yeah, I don't think it has fundamentally changed. I mean, there were some other factors like an expected slowdown in the US economy, an adjustment in monetary policy outlook implicitly that all kind of helped the dollar to decline a little bit. But I think the real threat to dollar dominance right now, at least, while there's no alternative, comes in a way from within. I mean, we're having the objective of shrinking the capital account, the current account deficit, while we're running still a really loose fiscal policy. We have issues with the labor force and immigration or education at the moment. There's also a question of huge energy demands, but some energy projects are cancelled. So there is some contradictions, I think, between the objectives of the administration and what actually is happening on the ground. Now, this doesn't mean that, as we've said before, that dollar dominance is really a question right now. The only alternative to what we see, for example, from emerging markets and low-income countries would be the PBOC. There are swap lines that are expanding, but it's more kind of a political instrument that is helping that group of countries. But when it comes to really high finance, so to speak, I think the dollar is still the currency of choice. But I mean, having said that, again, the the renminbi is kind of on the march, quote unquote, because China is really expanding its relations with the global south. And these are countries that still have huge population growth, there's economic potential, and they're very grateful that the PBOC, or that China is not only offering these PBOC swap lines, but more importantly, they're actually engaging also in trade, they're providing export opportunities, whereas the US and Europe are a bit more closed in that area. So there is a transition underway. It will take a long time, but the US needs to make its homework and make sure that there is no problems to the trust in the dollar coming from within rather than from the outside, so to speak.
I'm glad you mentioned China. And Dan, I want to go to China now. We danced around it. Let's talk about China directly. I think it's helpful for the audience that doesn't live and breathe this like those of us on the video do. Can you explain what China's actually doing on its alternative payment systems? There's Mbridge, there's SIPs. I think it's worth saying, what are they? How significant are they? Because there's a debate even in the US government about whether these matter or not.
That's great. I agree. I mean, it's good to focus on the details, especially when we talk about China. A lot of these things sort of happen in the details, and by the time they're a significant problem, maybe it's too late to adjust. So, yeah, I mean, the main things that China has really been focused on. Well, let me zoom out actually first and say this. And when we think about China as a potential rival, and the yuan as a potential rival to the dollar, I think the first thing to get straight is sort of what's motivating China to do some of these things. And this, obviously, as I said before, comes back to, in my opinion, concerns about sanctions and geopolitical risk. It's not that the Chinese are plotting to topple dollar dominance. This is often how it's characterized in the press. Anytime China does anything that gets attention regarding its currency, there's, at least somewhere in the press, a headline that sort of suggests that this is China coming for the dollar, right? And I think it's the wrong lens to look at it through. I think the right way to think about this is defensively motivated, right? That China has seen and learned about how the United States uses the dollar, and the best way to prevent China from being vulnerable to those same kinds of moves is to increase the yuan's use internationally, in particular in cross-border payments and trade. And so that's where SIP's cross-border interbank payment system, which is effectively analogous to chips in SWIFT for the dollar, a correspondent banking network where Chinese banks are the hubs that are connected right to hundreds, now over 1,000 banks around the world in over 100 countries. And it's been growing. Now, it is substantially smaller than the dollar payment network, right? 30 times smaller, I think, by my most recent count. So, but the growth is there, and it's happening. I think it's quite intentional. You mentioned Mbridge. Mbridge is sort of a multilateral CBDC network between China and some key partners in the Gulf and in Asia. And I think these are just examples of China pursuing different ways. It's not that different from this conversation about diversification. It's maybe China doesn't know exactly which of these models is ultimately going to be the potential solution, the way to insulate themselves from US pressure. And so you might as well try to innovate in all these ways, and then if that moment comes, hopefully you're prepared.
Okay, now it's time to go digital, and Elizabeth, I'm going to turn back to you. We've talked about stablecoins. I want to dive into this argument. I interviewed Chris Waller, who oversees payments of the Fed, in February. He made the argument we've heard from Secretary Bessent, which is we're going to issue dollar-backed stablecoins all over the world. In fact, the majority are not issued in the United States, and there's going to be a demand for treasuries to back up these stablecoins, and that's going to entrench dollar dominance. And everyone's kind of walked away since then and said, okay, that makes sense. And I want to poke some holes in that argument and talk about it. Is that right? Can it deepen dollar dominance? Is that the scale where it really matters, given the size of the treasury market? And does it not produce a backlash in other countries who might be worried about the spread of dollar-backed stablecoins?
Yeah, no, I think it's going to be very interesting to see how this materializes. There is one scenario where you do entrench dollar dominance, and there's a first mover advantage by having legislation that requires the U.S. dollar-backed stablecoin, whereas Europe doesn't have that in their legislation. But I also think, and this is also hearing just from clients in the company that I work with, that there is a desire by other jurisdictions not to have dollar dominance result from this act. Now, are they able to promote their own stablecoin regulations that support that, or CBDCs in the case of Europe? Let's see, right? It's hard to know. So, and again, this market is pretty small right now, and how it grows, it could grow exponentially, but we need to see. It's just a lot of uncertainty. What I do think is interesting is that getting back to this point about the administration saying, dollar dominance is our priority, we want to maintain that. When you really look at the policies they're pursuing in order to maintain it, it is number one, the Genius Act and digital assets, and it's number two, foreign investment. And you see that with trade deals, right? Where, for example, Japan, they just announced that JBIC is going to be providing these loans and loan guarantees so that they can fulfill their $550 billion investment into the US as part of that trade deal. So those are two strategies, but they're strategies right now that are on the margin. Really what's carrying the dollar dominance is just, it's been there forever, right? And so it's self-fulfilling.
I know that's the argument that always makes me worried, the self-fulfilling. It's been there forever, so it will be there forever. Martin and Andreas, I saw you both wanted to jump in, so Martin, then Andreas.
Yeah, so as I said before, the administrations or the US general fiscal policy in the last couple of years has not been going in the right direction. I mean, some of this was necessity by COVID to have stimulus packages, but both administrations have not turned around the deficit. Now we have a growth-based strategy, maybe it works, but most likely we're seeing US debt expanding, according to the CBO. And that's one factor that inhibits long-term dollar dominance. Now, the argument will be, well, we have stablecoins, but stability of stablecoins, again, is predicated on the underlying assets, and stablecoins are subject to runs. And I haven't seen any regulation yet that inhibits that. Even if they're well regulated, investors can turn on a dime. So the argument that stablecoins will help on the dominant side is only valid as long as the fiscal position remains manageable. So it's not really adding anything to the dollar dominance, it's just shifting it from one leg to another one, but underlying all of that is the fiscal position.
Well, I'll make a point there, and then we'll turn to the audience, Andreas, after I come to you. But to the stablecoin run, if the administration is right and the Trump administration unleashes stablecoins, as is their plan, you could argue that stablecoins would become too big to fail. And the Fed would have to eventually step in should the stablecoins, and I think that may be a backdoor to actually the Fed backing the stablecoins.
Well, then you get slowly into fiscal dominance, which again works against the dollar as a reserve currency.
Andreas, you wanted to jump in, and I also wanted to get your view on this backlash point, whether any interest in the digital euro, which of course long predates the growth of stablecoins, but now the sort of push toward the digital euro, is there any connection to the US stablecoin policy?
Yeah, these are two questions. The first question about stablecoin, I recommend that Europe takes this very, very seriously, because not only as a means of payment and as a means of an additional currency, if you want to call it a currency, but also because stablecoins are actually the entry door to crypto. And the crypto world is a totally different world, and it may not only be used as a payment means of payment, but as an entry to crypto, and that could then lead to an exponential rise, and that could lead to an exponential support for the dollar dominance. So coming to your question about CBDCs, that we will have to see, but we will know rather soon. Mm-hmm. There is a big debate going on, and I'm not quite sure what the rapport in the parliament will be, which is coming end of October, as far as I understand it. But you have to prepare that the conflict, so to say, continues, and that on the one hand, the ECB and the other national central banks defend the idea of a digital euro, whereas the parliamentarians still want to be convinced about this use case. And as clear as it is that a wholesale CBDC makes a whole lot of sense, you can debate about a retail CBDC. I personally wouldn't do that much, but you need to convince parliamentarians, and a lot of money has already poured into it. The debate I foresee is a debate about tokenization versus CBDC, and what can tokenization actually do, and to what extent do we then still need CBDC? But we will know by the middle of next year for sure how where this will go actually.
We can't wait at the center to find out.
You have to wait until the middle of next year.
Yeah, I'll be very brief because I know when we get to the audience. I'll just say that I, for one, worry a bit about a strategy to maintain dollar dominance that bets the farm on stablecoin and abandons things like central bank independence, a commitment to a strong dollar, a commitment to European security. I don't think that's an even trade, and it's not a bet I would make. So I'll just leave it there.
Okay, well, we've said enough things for people in the audience to disagree with. So please, questions. We turn to the floor. I have some online, but I want to turn to the floor first. Otherwise, I'm going to call on, yes, Maria, please. Oh, yes, we'll get you one. Jesse has it.
Thank you very much. I just wanted to maybe add 2 points for the panel to discuss. One is gold, the price of gold and the quantity of gold that is being sold as a result of all this turbulence. How do you panelists view this? And then the second is something that is a little bit technical, but one of the main reasons why the dollar is really an international currency is because of the swap lines. The Fed had always provided liquidity during crisis, which actually allowed global markets to function when nobody wanted to buy and sell. So questions here, will the Fed continue to provide swap lines in times of shock? In particular, since as you mentioned, the issue of independence, the Fed is moving from technocratic to more political. Will there be a will to support international liquidity in times of crisis? Question one. And of course, on the other side of the continent, which is here, would the ECB like to step in and pick up some of the swap line demand from, particularly from currencies that are now under sanctions, by means of internationalizing the euro more than it does today?
Okay, great questions. Obviously, when it comes to Argentina, the Fed is willing to do swap lines, but whether that's a broader argument. Martin, you want to jump in, and then I'll turn to the panel on the gold question, and Andreas on the ECB question.
Yeah.
But Martin.
Argentina, I think it's the Treasury, not the Fed.
Well, the Fed will have to be involved at some point.
But so first, I think, Maria, these are good questions. And I think on gold, there's just not enough gold around to really kind of shift. Now, obviously, it has gone up because of uncertainty, but we would see astronomical levels if it were to really be an alternative to treasuries. On the swap lines, some of the most important swap lines are permanent, and I have not seen any indications that there's any idea of canceling them. This would be a major market event. What happens during a crisis is that additional countries get access to dollar swaps. But the reason for that is always that the Fed deems it necessary to manage risks to its price and growth mandate by avoiding volatility in dollar markets elsewhere. And that's been kind of always the justification during the global financial crisis and during COVID. And it would again be in a future crisis because it's the monetary mandate that they have. So I don't see any risks from that particular side.
Gold, and then I'll get to you on the ECB point. But anyone want to weigh in on the gold question? What we make of it?
I mean, I think it's a couple of factors. I think it's an inflation hedge. We've been in an inflationary period. Gold has maintained its value, increased its value quite a lot. And if you bet on gold as a central bank, you're probably feeling pretty good about that. I think it's to some extent a signal that this, there is no alternative argument. It's true, and yet central banks are searching for alternatives. Gold, yes, supply is an issue. But I believe now, in terms of valuation terms, the share of gold in central bank reserves actually is larger than the euro at this point. So it has taken on a pretty large chunk of reserves, and that's a huge change in the last 20 years. And the third thing is sanctions, right? The Russians, the Chinese, the Turks, these have all been major buyers, all countries with experience and concerns about US sanctions, and gold in a vault is pretty safe from Washington, despite its limitations.
And the ECB point, would the ECB step in and fill in some of this role?
Maria always asks very good questions. So I have to say one sentence about gold. You know, the issue is in gold, it's not only physical gold. We have a lot of derivatives on gold, and there is a danger and a risk if all of that would be called at the same time, and there would be a run on gold, and then there could well be a situation where banks couldn't fulfill those derivatives, and we could have I wouldn't say a panic, but a very complicated situation. So gold is a special topic which needs a lot more consideration than in the past. And there's a paper out on derivatives on gold and risk, and Maria knows that anyhow very well. Now, the second question is about the swap lines. It's not necessarily an ECB question, it's a US Fed question. And it's important, of course, what the Federal Reserve does, but it's also important what people think it could or could not do. And that feeling that maybe the US wouldn't stand behind swap lines in the future has increased during this year, and that makes me not feel very well about it. I'm not saying it will happen. I don't think the Fed has any intentions, but of course, could there be an executive order ordering the Fed not to fulfill those swap lines? I have no idea. I'm not a lawyer, and I'm worried about this. Now, could the ECB do something? I'm not going to advise the ECB in that regard, but I don't think that the ECB is powerful enough. But if they were to work together, let's say with the Bank of Japan and others who are in a similar situation, not only in terms of dominance of the currency, then you would be talking different things. I hope this is not necessary. I like the system as it is right now.
Fred, I think you had a question. We'll get you a mic.
Josh, maybe on the swap lines,
please,
real quick while we're waiting. I kind of disagree. I think the Fed swap line is a feature of dollar dominance, not a driver of it. I mean, these swap lines were put into place well after the dollar has been dominant. And I think I also don't have any inkling that the Fed would be canceling these, but totally agree with Martin that this is aimed at providing liquidity in a crisis so as to preserve, prevent risks to the U.S. I think if the Fed were to announce some sort of, pulling back from them, the concern is more about the signaling and the overall environment of what are we looking at in terms of an independent Fed, how independent is it still, as opposed to the actual amounts in the swap line.
I tried to say the same, but this was, of course, much clearer.
So Josh knows that Fred Kemp, Atlantic Council, Josh knows I'm a geopolitical guy. And so, first of all, this is riveting. Any of you have gone to rock concerts, and I remember the most famous one I went to, Rufus was Warmack back, then the Eagles, and then the Rolling Stones. And this is the Rolling Stones for our group, right? I mean, but I must tell you something. This is a brilliant discussion. I even kind of understand it. But here's my geopolitical question. My geopolitical question is what are you watching for to see the shift? Is it a Treasury auction gone south? Is it Fed independence disappearing? So what we're picking up at the Atlantic Council when we do IMF World Bank meetings is we convene all these finance ministers, central bank governors, and a few years ago they said there's nothing to replace the dollar and they didn't want something. Now they're saying there's nothing to replace it and they want something. And so to me, and how is all of this then, first of all, the answer is what are you watching for? And the second is, how do you know when it's signaling a geopolitical shift from what you've seen in history? Because that's what I'm really watching is, how do I put your thinking together with whether or not the US is losing its edge globally in some irretrievable manner?
I think this is such a key question, and Saleha Mohsen spoke about this earlier. You often don't know that it's happening in real time. This is the history of currency changes, and you look back, and then the indicators, and Fred, your question, and the question I'll turn to the panelists. So what should we be looking at? Who wants to take it? Martin?
So you mentioned earlier the paper that came out, and I did that with Valbona Zinelli, also from the Atlantic Council. We tried to look among all the other factors a bit into the geopolitical combination. There's a debate among academics. Some say, well, it doesn't matter whether you're a global hegemon for providing a reserve currency, and we took a bit of a different line, and there's also some papers to that regard out there. I think if you look at the US right now, in terms of its military exposure potentially, it looks a bit extended, because China has been catching up rapidly. There's some choke points in terms of replenishing key materials. Some of the weaponry is a bit outdated, and it's slowly being invested in. But if the US, for some geopolitical incident or ever, loses the perception that they have an edge over every opponent, I think that would be a major geopolitical factor against long-term continued dollar dominance. Because in the end, you trust that when you put your money in the US, you'll always get it back with a return. And that is in part because you believe that the US is stable, it's kind of not assailable, it can defend itself, it can get its policy targets implemented. And if they take a setback on that, people will doubt that this is always going to be the case. So in other words, political and military capacity play a role for dollar dominance. The British Empire experienced it at some point. It doesn't have to be always the case, but I think this would be a major turning point, not only in geopolitics, but also in geoeconomics.
Yeah. I think that's well said, and I think the way we think about this at the center is we should pay attention to the demand signal, where you're talking about, Fred, and alternative payment systems are demand signals, in my mind, because they're indications of a desire to de-dollarize, and they're pipes. And eventually water flows through those pipes, even if that takes many years and is a long way away from challenging the dollar. We're out of time, but I want to end with a lightning round as we conclude the Transatlantic Forum, and then I'll welcome my colleagues, Julia and Jorn, to wrap us up. But here's the lightning round. When we convene for the 10th annual Transatlantic Forum on Geoeconomics, wherever that will be, so 6 years from now, is a two-part lightning round. Will the euro be stronger as a reserve currency and the dollar weaker? Will they be the same? Will one be stronger or weaker? So where's the euro 6 years from now in reserve currency status? Elizabeth, put you on the hot seat first.
Dollar will still be dominant, but euro could be stronger if this current environment creates an impetus for change in Europe.
Martin?
I'll vote for the same.
Dan?
I expect the dollar to continue to slowly lose market share, and I think the euro will continue to grow.
Andreas?
Things are going well for the euro right now.
Well, what a note to end the Transatlantic Forum on. Please thank our distinguished panel.